The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho, and these are your headlines. Huge deal has just taken place. India and its Prime Minister Narendra Modi says a big agreement has been struck between the EU and India, whilst Commission President Ursula von der Leyen hails a new free trade zone of 2 billion people.
President Trump hikes tariffs on South Korean autos and other goods to 25%, while geopolitical uncertainty sends metals to new heights in their record rally, with silver lining up its best month in over 4 decades. Puma shares surge in pre-market trade after Chinese sportswear maker Anta strikes a deal to buy a 29% stake from the Pino family.
I don't want to do cultural appropriation here. Good morning, everybody. But I am very aware of the fundamental Chinese philosophical concept around dark and light, passive and active. We're talking about yin and yang.
Yin and yang, yes.
Yin and yang. And again, I kind of try and balance the world out in my own life. And I think when I am more balanced, I'm a better person. And when the world is in balance, it's better. So I just think we've just had yin and yang in our headlines here. We've had a massive free trade deal being talked about, and we'll talk a lot about this in coming hours and weeks, maybe. Massive free trade deal, so barriers being shut down. And in your headlines, we're talking about potential more barriers going up because the US president is concerned about a China-Canada deal. He's concerned about the pace of adoption of a trade deal from the South Koreans. And I just think that is a bit of a yin and yang going on in the world.
It's almost passive-aggressive, isn't it? You've had this aggression from the United...
Almost.
Very much
Let me
so.
disagree. Passive-aggressive or just aggressive?
So you've had this very aggressive tactic from the Trump administration on tariffs. Other countries negotiated quietly those tariffs away, but at the same time they've looked at other markets to try and find resilience. So even while they've said yes to the president and the tariffs, they've very much said, well, we're not taking it lying down, we're going to do deals elsewhere.
So the dust is continuing to settle from what was a tumultuous World Economic Forum. Yes, I'm still in shock about it. And a reordering of global trade in the wake of President Trump's threat on Europe. After nearly 2 decades of negotiation, that's how long these things take. They take a long time. After nearly 2 decades of negotiations, the EU and India have struck their own FTA. EU Commission President Ursula von der Leyen says the two sides will grow their strategic relationship further. The Indian Prime Minister Narendra Modi has teased the announcement this morning, saying, quote, a big agreement has been signed between the EU and India. Now, separately, UK Prime Minister Keir Starmer has said he will not be forced to choose between relations with the US or China ahead of a trip to Beijing starting today. The UK was amongst those initially targeted by President Trump's tariff threats over Greenland. And the US leader has continued to use the threat of tariffs to coerce countries to fall into line, with the Trump administration saying the White House is raising tariffs on some Korean goods from 15% to 25%. In a post on Truth Social, Mr. Trump accused Seoul of failing to uphold its side of a trade agreement. Look, just like the Mark Rutte comments on NATO, and we'll come to that later on the show, where he says, look, forget it, Europe, you cannot defend yourself in the short to medium term without the United States. Absolutely. So in the same vein, I'm saying, forget it, world, if you think you can trade without the United States. It ain't going to happen. It's the most powerful, most important economy in the world, and they happen to have something called the dollar as well, which we're all trading in as well. But countries are realizing, they're waking up and smelling the coffee, perhaps non-tariff coffee, maybe tariff coffee, I don't know. But they're waking up and smelling it and saying, we need to make sure we are diversified or have a little bit of an offset strategy. I think you yesterday were talking about China plus one. It's the US plus one strategy, which I think people are looking at.
The reality is these deals were multi-decade negotiations that went nowhere, and that was from Mercosur to India and Europe. Now, all of a sudden in 2026, we're talking about these deals coming together. So it does tell you about the motivation that's been pushed to one side. The fact that you've got the Americans so forceful on tariffs. Now these other deals are just simply going through. Will they be good for populations? That was something we got into the weeds on in Davos the other day, whether these big deals are the right course of action.
Look, I kind of studied a bit of this at university, and I'm sure you did as well. But look, big nations love bilat because they can bully other nations. Because the bigger you are, the more pressure you can put on individual nations. That was way before Trump. I was studying this, Bush era or whatever. So big nations like bilat. Smaller nations like multilateral deals as well. Hence WTO type deals, global trade deals, GATT type deals, which took forever. Doha round take deals, and they take a long time. That's the fact.
So just a couple of pointers here. What it means for India, you've got textiles, you've got leather, gems, jewellery, machinery. Those are some of the wins for the Indian market. For European products going into India, autos, and we know there's been an enormous challenge on autos, given what we've seen with the Chinese competition, transport equipment, wine, spirits, other industrial goods. And I think some of those things are self-explanatory when you've seen wine and spirits set front and centre for the Americans too in terms of tariff targets. Let's take you to the market action. US markets yesterday, this is how they performed. Across the board, we saw a bounce. We had somewhat uncertain activity pre-markets, but back in the green is the course of trade. Apple, one of the big trades as well. The market looking at the ability of the company to push the boat out on products, AirTags, and some of the innovation there widely watched, and the AI story. The Asian markets are picking up on that US action. You can see in the green, the Japanese stock market bouncing. Hong Kong, South Korea, Kospi, Asian market at a fresh all-time record in trade today. So again, we are seeing that upside. To the platinum, silver, gold trade, the precious metal trade has been again on a tear this year. The geopolitics that we saw last week in Davos very much putting the bid back on the table for these trades. Spot gold, we are still more than 1% in the green today and travelling very close to the 5,100 point level. Silver slightly firmer, as you can see. Again, that run seems to, there's no obstacles. It's just pushing on an open door on that trade. The platinum bid this morning is a little bit weaker, though, in context versus the others. Futures here in Europe, this is how we're gearing up for the trade. It looks as though we're chasing, again, more upside on the European markets. Let's get to David Page, Head of Macroeconomic Research, Australian Super. David, thank you very much for joining us.
Pleasure.
The strength of the macro very much being debated internationally. What are you seeing? What's the most pressing factor on the macro side for you this year?
Well, I think there's uncertainty going further forwards. I mean, across the board, we're more confident that we are going to see a decent year for growth. I mean, the US looks like it's ending the second half of last year much stronger than people thought. And we already thought that the tax cuts, the rebates that are going to come through, are going to give a little bit of a lift as we went into this year and importantly into the midterms. But again, for China, we think that they're going to push a little bit more to keep that economy going. First year of the new 5-year plan there. And Europe, I think, should see the benefits of cutting interest rates, lower inflation rates, all boosting consumer spend, and some investment boost obviously coming as well. So generally a more upbeat year, I think.
President Trump last week on stage in Davos was talking again about when the US has a boom, then the rest of the world benefits. But this time round, we've got very targeted tariffs, very country by country attacks that have weathered the Trump administration so far. So is it the case that the entire world economy benefits when the US does? Or is it different this time round because we don't know where the next attack's going to be coming from?
Well, both. I mean, historically, it's always been the case that stronger growth from the US has been a key driver, right? But we're not seeing that coming through so much because of not just the tariffs. I mean, in many ways, the tariffs have had less of a disruptive impact on growth, at least so far, than we'd expected. And that's either from the US side, where inflation's not picked up by as much, or on the other economy sides, we think of Japan, for example, where we've seen less of a sort of bite of those tariffs. But this geopolitical uncertainty is causing a lot of issues. Now, obviously, some sectors benefit from that, and we can see from defence stocks that there's a big push into those areas. But otherwise, that uncertainty is going to be a headwind, and it's going to continue across the course of, certainly this year. But we also think beyond the midterms, because we do suspect that midterms are, to some extent, you wouldn't guess it from what we see, but constraining the administration at the moment. So there are questions as to what the next 2 years could bring.
First and foremost, where have you been? You're an old regular of Scoreboard. It's genuinely lovely to see you.
Very nice.
Where have you been?
Well, here and there, all around.
Well, it's really nice to see. How long has it since you've been on the show?
Back here for quite a while, about 10 years, I'd have thought, yeah.
10 years, gosh.
It used to be almost a second home, right?
I know, right? Well, it's lovely to see you, and we've missed you. We'll see you again in 10 years, no doubt. But before that, just tell me a little bit about, I just made something up, as ever I do, and I was thinking about US +1. I was just drawing on the China +1 strategy, where people keep manufacturing in China, but they obviously diversify to just offset some of those risks that you and Karen were just talking about as well. US +1 strategy, I'm formulating the idea, I'm working on it as well, but I think a diversification strategy is absolutely essential for everyone now, isn't it?
And that looks like what we're seeing, right? So this is, Carney, as ever, voiced it very well last week with his one word of rupture. And I think that is what we're now seeing, a shift in the geopolitical norm. And that shift in the geopolitical norm also means a realignment of trade. So we saw it from Canada with their alignment with China, or at least the starting of the thawing of relations there. And we now see it from the EU with India. There's no longer an acceptance that you can just have the US as a bloc and a trade. And so we are starting to see that diversification. But this is a process that's going to take a long, long time. Right?
But my caveat to that, David, is what you just mentioned in your second to last answer, and that was about midterms. If the president loses control of Congress, which could now, who knows how the Democrats can blow themselves up, we've seen them do it many times, but if he loses control of Congress, it's actually, he's going to be tempered in what he can do, left, right and centre as well. He's going to have another one of those constitutional constraints maybe put upon him by, funnily enough, the thing called democracy. Do you believe actually then that's going to negate the worst of what we've seen so far in the first year of Trump?
In the run-up to the midterms, we think the administration itself should be tacking a little bit softer. I mean, we've been wrong so far in the first few weeks of this year, thinking that the administration would temper some of its more aggressive global policies so that you have a smooth economy that gives a decent boost into the midterms. Post the midterms, though, of course, there's a question mark as to how much Congress is going to bite back. We are starting to see a little bit more resistance from Congress, but it's been pitiful, at least from the Republican Party, over the last sort of 15 months or so. But beyond that, most of the geopolitical element is driven by executive action. So a lot of it can go beyond Congress. And that, I think, is historically what we've seen from late-term presidents anyway, and could doubly be the case in this position.
And yet, the US president is presiding over a stunningly strong, on the surface, US economy as well. And quite rightly, he can laud the fact that actually in his first year, the pessimists have been wrong and he has been right. Now, we can talk about K-shaped to a blue in the teeth, we can talk about the inequity of the US economy, we can talk about concerns building up on inflation, but at the moment, ceteris paribus, the president is winning on his battle at saying this has boosted the US economy. Is that not going to boost the world economy?
Yes, it probably will. As I say, we are more positive on the global economy. It's a little bit of a moot point as to why the economy is booming. I mean, it's not booming because of the US policies, right? It's not booming because they've employed tariffs, and it's not booming because of their geopolitical strategy. It's booming because underlying there's a technological wave coming through as well. So we see a lot of strong investment coming through, very big numbers that are driving some of these hyperscalers, and that is boosting the stock market. The stock market looks like it's pushing gains through to the consumer, and the consumer is therefore able to spend more. Now, the current reading is that US saving rates are falling back quite low, and that US households are having to tap into their savings. But we've seen this story play out a number of times, right? And the BEA will then subsequently go back and say, do you know what? Actually, income's been a little bit firmer, saving rates aren't quite as low. Households are making quite a lot of money out of this. And you say that the K-shape is very important. It's not all households that are making this, but a lot of those that are spending are getting a boost from the AI boom coming through stocks. Yeah. And while that tailwind continues, you're going to continue to see very good strength.
David, let me pick up on the AI story because it is a macro event these days. We've seen how dominant it has been for the US economy, the heavy lifting that has come through from AI on the growth story. But the disruption is still yet to be felt. And that was the story from a lot of tech leaders in Davos calling for more adoption of AI. How do you think it plays out from here, and when does it have consequences for productivity as well as job disruption?
Well, what we do know about this is it looks like it's another general purpose technology, right? And these things take decades to play out. So what we don't know is what AI is going to do for us. There are a lot of assessments at the moment about the task replacements that AI can do, but that's sort of back when the internet came in, we all used it to do our shopping. The real boosts of the internet come from when you start reimagining how the workplace works. So that's very difficult to anticipate. So all we can do really is look at history and see when these boosts do come back. Now, we think we will start to see some productivity uplift as we move into the next couple of years. Probably not now, probably not this year, but maybe 27, maybe into 28.
Let's go with the scenario that AI does change the world and has this productivity uplift, and we all have to stop worrying about jobs, but we'll think about that bit. Let's say it all works as we're told it does. I'm still not convinced that it's going to be American technology that the world is using. And I'm not convinced necessarily that it is going to be the American companies who have spent this vast amount of money who are just going to trounce the Chinese, who are just going to trounce people from the Middle East, who are going to trounce everyone else as well. They may do, but if they don't, there's an awful lot of money that's been spent that won't actually turn into a solid ROI.
No, absolutely. I mean, if you look at the railway boom back in the day, it wasn't the railway producers.
On both sides of the Atlantic as well.
Yeah. But it wasn't the railway companies that we think of as the big companies. When you look at Ford introducing auto production coming through there and mass production, it wasn't just Ford that benefited from that. And AI isn't going to be the AI producers that benefit, it's the users. And that really hasn't started to be priced in quite the same way. So it's the finance companies, it's the legal companies, it's the customer services, all of those that can embed AI and see significant productivity gains, which hasn't really started yet. That's where you'll see the real boom. So yeah, we are seeing obviously a very strong pickup from these tech companies at the moment. Some of those are going to fail, much as some of the AI, some of the IT stocks that we saw in the late 1990s going into 2000 failed. But actually the sort of broader benefit, the macro level benefit, comes beyond just the tech producers.
So down to the point, how careful do you need to be around AI exposures? Because there is a view now that it's not just a tech, a small, narrow handful of companies. It is now equities more broadly that's exposed to AI. It is the bond markets, the credit markets also more exposed because of the amount of issuance that is happening. It's various different sectors, utilities, industrials getting dragged into this cycle, and by and large big economies as well. So when you think about the lessons that history has shown us, is there any way to be somewhat distant from the AI trade just in case there is still some sort of bubble-like story yet to unfold? Or is that the wrong strategy? Do you not want to be thinking about that because it's such a wide topic now impacting so many parts of society?
I think it just impacts so many parts of society, and the fact that we've got, for example, as we just talked about, very strong US consumer growth, which isn't a product of AI per se, but is an indirect effect of the pickup that we're seeing come through in wealth. It is ubiquitous across the piece. So what does history tell us? Well, it tells us we've got to be very cautious, right? But it also suggests we do have several years of tailwind coming through here. Now that's not to say that we can't, we'll be fearful of the irrational exuberance that we all remember from the late 1990s, but we should be seeing this tailwind continue to come through. And if we're right, it should be something that boosts growth, subdues inflation to some extent, but is going to be very difficult to spot in real time, and that's always the trouble with tech development.
David, lovely to see you. I presume you're not going to leave it another 10 years before you come back and see us?
I'll leave that to you.
He's been very busy. He's been managing the big pension pot in Australia.
I know what he's been doing, because I've got his whole CV in front of me on LinkedIn.
So we think he's managing some of my money too.
Well,
if you're an Australian, you've been managing.
I'm just looking at the photo on LinkedIn though, David. Might need updating. But you're looking great nonetheless. David Page, Head of Macroeconomic Research at Australian Super. Right, coming up on the show, the mother of all deals, India and the EU ink a free trade agreement nearly 2 decades in the making. We'll bring you the European Commission President Ursula von der Leyen's press conference in around 30 minutes' time. Plus, UK Prime Minister Keir Starmer prepares a charm offensive as he jets off to China. Who's that for, though? His backbenchers or everyone else? And as natural gas prices whipsaw and oil prices fluctuate, we are privileged to speak to the CEO of Galp Energia, getting her outlook on the energy sector and what potential M&A deals could be on the horizon. That's after the break. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Parliament lawmakers have delayed a decision on unfreezing the ratification of the trade deal between the EU and US. The process was put on hold after President Trump threatened tariffs against European countries in his bid to acquire Greenland, whilst lawmakers have signalled they will now allow it to progress. Some have called for greater clarity on Trump's agreement with NATO over the territory first. EU countries have given the final green light to a measure banning imports of Russian gas by late 2027. The agreement will see Russian LNG imports halted by the end of this year and pipeline gas by November 2027 at the latest. Slovakia and Hungary voted against the measure and Bulgaria abstained, while Budapest is vowing to challenge the law at the European Court of Justice. Well, fascinating backdrop to speak to one of the important CEOs in the gas arena as well, Maria João Carioca, who's the CEO of Galp as well, which of course is the Portuguese-based group as well. Maria, thank you for joining us.
Thank you, Steve. Thank you, Karen.
I think I can ask you a very generic question at the moment, because there has been so much going on over the last couple of years in the gas space and so many great efforts to diversify the European supply, and actually now an acceleration of weaning ourselves off the Russian LNG, and hence that money doesn't go to their exchequer as well. How would you typify things at the moment?
Thank you for having me. So true. I mean, just last week we were in Davos discussing what was going on in the world, and so much of it was about energy, and so much of it was about energy independence in Europe and elsewhere in the world. So here we're at Galp. We'll look at it as one of our core focuses. So being a Portuguese company operating internationally, Brazil, Africa, Iberia, diversifying our portfolio is of absolute core importance for us. So a lot of what we do is about balancing the continued need for upstream. So there's still growth in upstream, and that's been historically our driver. But also to increasingly look at how it is that in Iberia, particularly where the conditions are there, how can we build a platform for European energy independence and sustainability?
And that's a great point. And I remember being in Garmisch listening to Draghi talking when he was Italian Prime Minister, rather than him of the report or him of the ECB, and just saying we can do it, and just saying the speed with which the Italians wean themselves off Russian gas. It was a great example of that, what could be done. But you mentioned something very important there, that what Southern Europe, what Iberian Peninsula can do for the rest of Europe as well. And it's that transfer of that product, which I think is still the product. The grids is the product, the willingness to break down the regulatory barriers as well. There's a lot of work to be done.
Yeah, a lot of work to be done. And I think as Europe understands the need for this energy and otherwise independence, I think the conditions, we expect them to be coming in and to come in place. But there's also a lot to be done on the corporate side, of course. So part of what we're trying to do, and you will have listened, heard about our recent deal with Moeve, it's exactly in that direction. We do feel that Iberia has a lot of unique conditions to contribute to green molecules coming into Europe, not just electrons, but also on the molecules. But that requires scale.
That's a contradiction in terms, isn't it? Green molecules. I mean, it depends how green those molecules are, I guess is the point.
Precisely. And I think the conditions where in Iberia you can actually bring the green electrons to produce green hydrogen. So have it full cycle.
Sorry, we're going to get technical here as well. Can we do that now? The electrolyzers at a stage now where
Absolutely.
we can actually use green electrons to provide the water source.
Absolutely. That's precisely one of our largest investments right now. So we've just deployed our first 100 megawatts electrolyzer, ongoing construction, but probably one of the largest and certainly most advanced in construction right now. A lot of plans in that direction in Europe. And all those plans, all that investment are precisely at the core of what we're trying to do together with Moeve. Acknowledge that we have a lot ahead of us in increased certainty for the regulatory context, but also in how to deploy those investments in a way that, actually meets the hurdle for a healthy investment. So getting together and joining forces is to us one of the pivotal ways to move forward.
Maria, I had a terrific conversation last week with Andrew Forrest over at Fortescue, who is looking at green hydrogen, bringing some of this technology into Europe. And he was highly critical, saying, look, all we needed from Europe was some sort of demand signal. We didn't need a pricing signal. We just needed the fact that there was going to be a green light, that there was going to be access, an element of what sort of demand could be lying across the block. We haven't had that. Even though there have been discussions with the Europeans, we've not had a demand signal. What can you say about the approach from regulators here and European leaders that could be more conducive to ensuring there are renewable solutions in the bloc?
Yeah, we see this ongoing dialogue as somewhat natural, as a lot of these markets are very young markets. We do welcome, and we often ask for, and we cultivate the dialogue towards much greater clarity and much clearer frameworks for What is supported? What is the direction? What are the conditions? What are the timelines? A lot of these investments are very long-term investments. You need to have a timeline of clarity, a timeline that directionally gives you some certainty to support investments. Otherwise, de-risking the amounts of investment that go into these infrastructures and to these new capabilities becomes really complex in the corporate world.
Let me dig into the Moeve story. And you were effectively trying to create a very large refinery in Europe. That is the wash-up of this manoeuvring. What does that mean when it comes to the geopolitics that we've seen? The story around Venezuela, where the president has swooped in with an operation there about getting cheap oil. How do we think about greater refining capacity in Europe?
Refining is one of the aspects of the deal. The deal also goes into more of the household retail services, but it does bring together our refinery in Portugal with Moeve's refining capacity in Spain. So this creates an Iberian cluster that will allow us fundamentally to get scale and the ability to optimize investments. So if you're a refinery in Europe, you're permanently struggling with everything else that's going on in the world, with all the infrastructures that are being built elsewhere, and you're permanently struggle to survive into the next decade and to do so in a way that is sustainable and delivers the right returns. So optimizing on a set of refineries instead of just on our current one, in the current context where we see other refineries emerging elsewhere in the world, is probably one of the best tools we can envision to ensure sustainability in the future. So you optimize investments, you do it on a grid approach, you make use of not just your internal market in Iberia, but also our Atlantic-facing coast and our ability to reach as far as the North American market. So to us, it's the bringing together that will unlock not just the scale, but also the scope that we can address with this new joint venture.
Director, just give me permission for one more question. Has Europe dropped its naivety towards, and again, I'm going to molecules rather than electrons. We've gone ahead with green deals, and a lot of people have criticised Europe's naivety about what electrons can do, what green energy can do, what renewables can do. And I look at deals like you're doing with Total and Namibia and what have you, and I think actually we need more of this as well to safeguard our future and to safeguard the energy transition rather than less of it as well.
We at Galp believe so. So we still see this balance between making sure that we remain very focused in delivering the growth that we still see as necessary in upstream. So hydrocarbons, oil and gas, there will still be a part of energy outlook in Europe and in the world. Certainly demand is there, and the pace of demand requires that good projects, such as the ones we have in Brazil that are delivering very low CO2 emissions oil barrels, still oil, but the best you can probably get. Namibia emerging as a new basin, also making sure that there's, again, good quality oil coming into the market. But then leveling that and balancing that out with continuing to focus this growth in good projects, but also bringing in the options for growth that we see in electrical demand, so in renewables and green molecules, as we put it. We believe that the only way to deal with not being terribly naive about where demand is taking us and leading us is making sure that portfolio is balanced out. And we believe that's true for our company. To an extent, it's also true for what we see for Europe, but you need to have multiple options.
That's what I hear from some of your great partners, such as Mr. Pouyanné as well. So lovely to see you. Thank you so much indeed for joining Karen and I. It's really nice to learn more about your story.
This was a pleasure. Thank you so much for having me.
Thank you very much. Maria Joao Carioca, who's the CEO of Galp, with us.